VUG and SCHG are two top-tier growth ETFs available today, and we will compare them across 5 criteria: strategy, fees, diversification, holdings, and performance. So if you have any future video suggestions, please comment below. If there's enough interest, I'd be happy to create more content for you. If you find this video helpful, please give it a like to support the channel's growth. And welcome to my investing channel. Don't forget to subscribe if you haven't already. Let's start with the first criterion: strategy. VUG, the Vanguard Growth Index Fund ETF, is a market cap weighted ETF that bases its weights on company market capitalizations. It tracks the CRSP's Large Cap Growth Index, which includes the major growth stocks listed in the US stock market. This ETF contains 200 large cap stocks identified as growth stocks on US exchanges, selected for their high price to book ratios and forecasted growth. SCHG, in contrast, tracks the Dow Jones US Large Cap Growth Total Stock Market Index. This index includes the top 250 large cap growth companies from the Dow Jones Total Stock Market. The index classifies growth stocks using 6 measures: projected price to earnings ratio P, projected earnings growth over 3-5 years, price to book ratio, dividend yield, trailing revenue growth, and trailing earnings growth. Both VUG and SCHG are market cap weighted and growth focused, following similar stock selection strategies. However, I slightly prefer SCHG, so I give VUG 7 points and SCHG 8 points. Next, let's discuss the expense ratio. Portfolio turnover, which measures the percentage of the portfolio's value bought and sold annually, is 5% for VUG and 4% for SCHG, with VUG having a slightly higher turnover. Despite this, both ETFs have a minimal expense ratio of 0.4%, which is exceptionally low compared to European ETFs, even those tracking the S&P 500. So, American investors should appreciate these low-cost options. Given their outstanding expense ratios, I award 9 points to both VUG and SCHG, bringing VUG's total to 16 points and SCHG's to 17 points. Point number 3 is diversification, a concept some people highly value while others disregard. Personally, I believe in the importance of diversification. As a humble investor who bears a resemblance to Manu Ginobili, I agree with Warren Buffett's sentiment that diversification is a safeguard against ignorance. I acknowledge my own limitations. VUG and SCHG are quite similar, both focusing on the growth sector and being heavily weighted in information technology, which is currently the strongest sector and likely to remain so until the next market downturn. SCHG, however, is slightly more diversified with 250 holdings, which is ideal for an ETF. According to the ETF Research Center, there is an 83% overlap by weight between the two ETFs. This means that owning both does not provide significantly more value than owning just one. My advice is to choose one after watching this video and stick with it. While the overlap in holdings is around 60%, the primary difference lies in sector allocation. Here's a comparison of sector weights between VUG and SCHG. VUG has a strong focus on information technology, with 56.2% compared to SCHG's 46.8%. CHG offers more balance, reducing its overweight in technology and increasing its exposure to healthcare and communications. Given CHG's larger number of holdings and more balanced sector distribution, I believe it provides better diversification. Therefore, I'm giving 6 points to VUG and 7 points to SCHG, bringing VUG's total to 22 points and SCHG's to 24 points. Next, let's discuss the fourth aspect: holdings. Both ETFs concentrate on the growth sector and, as we've noted, have considerable overlap. The top 10 holdings in both ETFs is quite similar, with the only difference being that VUG includes Visa, while SCHG includes Broadcom. The total weight of the top 10 holdings is nearly identical in both, at around 56%. Despite the sector weight differences, the top companies significantly influence ETF performance. I appreciate that SCHG includes Broadcom in its top 10, and considering SCHG's 250 holdings compared to VUG's 199, I'm giving 7 points to VUG and 8 points to SCHG. This brings VUG's total to 29 points and SCHG's to 32 points. Let's move on to the final and likely most anticipated aspect, performance. While past performance doesn't guarantee future results, it's useful to know if you're investing in a past underperformer. Typically, ETFs can have varied performance across different time frames, sometimes better in the past year, worse over 5 years, and then better again over 10. However, that's not the case today. Both ETFs have shown similar performance both in the short and long term due to their growth sector focus and significant overlap. Interestingly, despite VUG's heavier weighting in the high-performing information technology sector, SCHG has outperformed VUG in both the short and long term. Year to date, SCHG has delivered a 7 to 8% return compared to VUG's 5.94%. Over the last 5 years, SCHG provided a total return of 119.8%, 17% annually versus VUG's 88.69%, 15.7% annually. In the last 10 years, SCHG again came out ahead with a 32.64% total return, 15.5% annually compared to VUG's 28.69% total return, 14.5% annually. To illustrate, a $100,000 investment in SCHG 10 years ago would now be worth $420,000, while VUG would have grown to $387,000. Both are impressive, especially considering that the S&P 500 would have returned $267,000 in the same period. However, remember that past performance is never a guarantee of future results. About a month ago, I released a video discussing the near future of the stock markets and the technology sector. In that video, which you can find here and in the description below, I examined the factors driving the markets and growth sector recently. I also discussed what needs to happen for continued growth and why I don't expect the same growth rate this year as in the last 12 months. Considering all this, SCHG appears to be the stronger performer. Therefore, I'm awarding 8 points to VUG and 9 points to SCHG, making SCHG the winner with 41 points versus VUG's 37. Now, an important question: do I believe the growth sector will remain dominant in the stock market? The short answer is yes, in the long term. I am confident in its continued prominence. However, I'm uncertain about the growth sector's development over the next 1 to 2 years, given its extraordinary growth in the past year and a half. Everything is reasonable, of course. AI came out strong, with companies like Nvidia seeing their profits grow tenfold within a couple of years. However, history teaches us that after 1 or 2 years of exceptional growth, there's a high probability of price stagnation or even a decline in the sector. Still, I hope I'm wrong actually. I really hope I am because my personal portfolio is heavily weighted towards growth. I truly hope this year and next, the technology sector delivers another 40%, and then another 40%, and even more. Since I'm not a financial advisor, I could be wrong about anything I say. That's why you shouldn't take my advice as financial guidance. But you should still subscribe to the channel to discuss finance with me and my community. You can also follow my investing journey. If things don't go well, you can say the Manu Ginobili lookalike is not only a bad basketball player, but also terrible at finance. If things go well, hopefully, you can learn from my many mistakes. So, what's left to say? I want to know what you invest in and what you believe in. Let us all know in the comments section below your thoughts on VUG and SCHG. And if you enjoyed this video, please drop a like and subscribe to the channel for more content like this. Thank you all for watching. Have a great day, and as always, I'll see you in the next video.